Hi, today my topic is all about understanding income statement. But first, what is income statement? Income statement is a summary of business revenues and expenses over the period of time. So, it is a summary of business revenues and expenses over a period of time. The basic form of income statement looks like this. So, income statement, income sample. So, expense. So, income statement is a summary of business revenues and expenses. Revenue, subtract our expenses from it. Then we work out for our profit or losses. We make profit when our revenues exceed our expenses, and on a flip side, we make losses when our expenses are much more higher than our income that we've earned. This is why the income statement, also known as the profit and loss statement, or the P&L for short. It lays out a roadmap, the income statement itself, for how we end up here at the bottom line, the profit and the loss. The income statement always covers a period of time, which could be anything that we want it to be. But typically, we run it for a month, quarterly, or annually. Take a look at our income statement as an example. Revenues less expense make us profit. But the problem with this layout is that it doesn't give us much detail, and it much better if we made a little more descriptive. For instance, this one. Saan ito? For instance, revenue are there are many types of revenue. If we're running a business that sells physical profit, then we might call them as product sales. But if we provide services, we can call this our service rendered. This extra detail helps the readers of the income statement better understand what they're looking at. Clarity is the aim here for the income statement. The same goes with the expenses. Business typically incur many different types of expenses. But broadly speaking, this can be broken down into two categories: our direct and indirect cost. Our direct costs of doing business are the costs which can be directly traced through the products we've sold or the services that we've provided. For business provide services, we might call this out for cost of service. And if we sell physical goods, then we can call this cost of sales or cost of goods sold. Direct costs, on the other hand, are the variable costs which increase in direct proportion to sale that we've made. If you're running a retail or a wholesale business, then this would include things like original purchase price of the product that you are selling, or if you are manufacturing businesses like San Miguel, then this would be include the cost of your raw materials or the direct labor cost that went into producing your product. So you have your employees, diba? As we make more sales, we incur more of these direct costs. When we take our revenue and deduct our direct costs of doing business, we get our gross profit. Here, this one, gross profit. If you are new in the accounting, then you'll soon discover that we have many different types of profit. Our gross profit is a really useful tools that allows us to measure the efficiency of our production and sales process. But let's go back to our indirect costs first. Indirect costs, these are the costs of running of business which can't directly be traced back to the production. So meaning it cannot see so it is the opposite of direct sales. It is the production of goods or the provision of services. Indirect, we sometimes call this as overheads. Overheads can include fixed costs like rent, employee salaries, insurance, admin expenses, legal costs, accounting costs, marketing costs, depreciation, and amortization. Fixed costs like this tend to remain the same. They bear no correlation at all to the sales that your business has made. However, not all overheads are fixed. Variable overheads can loosely correlate with a business sales, although they can't be directly traced back to the production of goods or the provision of services. These include things like advertising costs, which can indirectly drive sales and sales commission, and the utilities costs could also be considered as variable overheads. In a manufacturing businesses like San Miguel, this can increase as we ramp up production. When we deduct our indirect costs of doing business from our gross profit, we came up to our operating profit. So this one, operating profit. Operating profit measures the net income that we've generated from the operation. This is the residual amount that left over after deducting all the direct and indirect costs of doing business. So these are basic income statement. This one, help us to measure the business financial health. So the financial status of the business. It does giving us any means to compare our financial performance against comparative accounting periods. So, what is comparative periods? A comparative period is a different period of time, like comparing for this example, comparing the year 2000 and 2001. We can compare a current month or income statement against last month or year versus last year. When we use comparative periods, we can calculate the change or the movement across each timeline. So the timeline of 2000 and the timeline of 2001. Down the profit and loss statement of business. And as an accountant, it's our job to support this movement, which narrative explains all the differences. Let's use some numbers from our imaginary company. Imaginary company. Okay, this one, imaginary. So, for example, our imaginary company. Compare the movements of our P&L, the previous and the current, 2001 and 2000, for example. This imaginary company is going to be a medium-sized business. So we can quote this number in 1,000 pesos. So 1,000, naka-1,000 na siya. Our imaginary company has made sales for 110,000 pesos in 2001. 110,000. Which is up to 10,000 pesos from what we made in a prior year, in 2000. Our cost of goods sold also increased by 10,000 pesos. From 30,000 to 40,000, and that left us with a gross profit of 70,000 pesos, which has remained unchanged, so the same. Our overhead are fixed at 45,000, which give us an operating profit of 25,000 pesos in each period. In each year, rather. By 10,000 pesos, so what can we learn from all of this? So, well, our sales have increased. There's no doubt. But there's no doubt it earns 10k. It increased 10,000 pesos. But our gross profit has remained exactly the same. So, 70,000. How can it be? A useful metric can we use to analyze this group profit margin. So, to calculate the gross profit margin, we can use this formula. Gross profit margin is equal to product of sale minus cost of goods sold over dividing the whole lot of product sales. So, this measure how efficiency we're been producing and selling our imaginary products. In this case, our gross profit margin in the current year is 63.64%, and from that last year gross profit margin of 70%. So, how to calculate it? First, in 2001, our product sale is 110,000 minus the cost of goods sold is 40,000. This is year 2001 minus the whole product of sale of 2001. So 110. So 110 minus 40 is equal to 70,000 minus 110. So 70 divided by 110 is equivalent to 63.64%. So in 2000, our product of sale is 100,000 and minus the cost of goods sold is 30,000 divided by the whole product sale, 100,000. So 100,000 minus 30,000 is 70,000 divided by 100,000, which then came up the answer of 70%. So in this case, our gross profit margin in the current year is 63.64%, and from the year gross profit margin of 2000 is 70%. So one of the two things could be happening in this scenario. Maybe our sales can be shrinking, or our costs could be rising, or we could be selling more product but more discount rather, or the cost of our raw material could be rising. These are the questions that we need to be asked by ourselves as an accountant, or investor, or a small business owners. We can compare metric like gross profit margin, like this formula. Across comparative or previous years to help us identify what are the questions should be asking, and then that's the time the work begins. We need to find the answers and use them as a narrative that explain how income statement works. And that's it. I hope you find my video informative, and thank you for listening.